Hey everyone, and welcome back to the channel. Yes, we are going into why Booking Holdings is worth adding to your portfolio, the fundamentals, the news around the stock, and why I recently added the Booking Holdings to my portfolio. Because if you haven't seen the latest video on the channel on my portfolio update, you would see that the Booking Holdings was a new ad alongside Meta. So I'm going to show you what is the company doing, all the fundamentals that you need to know, just so if you ever wanted to look into a stock like Booking Holdings, you will know exactly what it does and how to look for. So, what is Booking Holdings? Well, Booking Holdings is one of the world's leading providers of online travel related services provided to consumers and local partners in more than 220 countries and territories through 5 primary consumer facing brands. So, it's one of the largest online travel companies in the world, basically. With a market cap of 144 billion, it has a dividend yield of 0.9%. 24,300 roughly employees are at the company, and it IPO'd in 1999. The key takeaway here is the scale. So when we're evaluating a company like Booking Holdings, it isn't just what it does. Does it dominate its industry? Does it have a global reach? Does it own its multiple brands? And does it have a long operating history? Well, for me, Booking ticks all those boxes, because their brands are Booking.com, Priceline, Kayak, OpenTable, and even more, which gives them a diversified exposure across hotels, flights, restaurants, and travel search. So this reduces risk and increases pricing power for the stock and for the company, which as an investor would love very much. Now, before we go into the fundamentals and all the other financial stuff, please do your own research. I'm not a financial expert, so please do your own research, because capital is always at risk. I don't want you just jump straight into Bookings Holdings because I said so, because that isn't right. Just because I added it to my portfolio doesn't mean it's right for you, because our risks could be different. And once again, I did my own research, and if I'm wrong, I'm wrong, but that was up to me. But I don't want you guys losing your money. So please do your own research. And once again, remember, I'm not a financial expert. So, how does Bookings makes its money? Well, before you see, there is a slide that explains right here what is the foundation of how it makes it. Well, there is merchant and there's agency. So, what is merchant and what is agency? Well, merchant is what travelers pay. So, travelers pay booking up front, booking pays the hotel later, higher margin, more control. The agency side of it is the traveller pays the hotel, hotel pays booking a commission, lower risk, lower margin. And as you can see, pretty much up to 2022, that was a 50-50 split. 2022 definitely, and even 2023, there was probably a little bit more towards merchant. But Booking.com have gone more into the merchant side. They want the traveller paying booking, so they get higher margins, more control, so they can get more money, which is good because that's what you want. You want the company to get more money, because Booking uses an asset-light model. They don't own the hotels, they don't own planes, they don't own restaurants. They just simply connect travellers with the providers and take the cut. That is how Booking do very well on. And it ain't just that the merchant revenues grow faster, which is probably good to increase profitability. The key metric also on this slide is the room nights sold. As you can see, despite it growing from 2017 to 2019 and then dropping in that crucial year that everyone knows about, from 2021 to now, it's grown. In the last 5 years, it's up 28.34%. Now that's good, especially when gross bookings is at 38% and growing. To me, that's consistent volume growth, consistent demand, and long-term upward trends. Which, for me, as an investor, if Booking delivers on all three, which they do, that's a tick. That, for me, their foundation, their fundamental of that is getting people to use their service is working. But what's the revenue look like? You could say, yeah, people are using this thing, but are they really making that much money? Well, yeah. to the data they are, yeah. So on here, the slide shows revenue growth, which from 2016 to 2025. So in the 1 year period, it's up 13.4%. The 2 year period is nearly up 12.2%. In the 5 years, it's up 31.7%, which is good. So 2016 was just over 10 billion, but 2025 it was up way over 25. Now that's good. It's good making money. So this tells you the business is growing steadily, despite having that year in 2020. The recovery is complete, I think, from the pandemic, and travel demand is strong still, despite the news lately. But this slide also breaks down its segment by revenue. So, as we mentioned last, the merchant, which is the largest and fastest growing, is making most of the money. Then you got the agency, which is stable, recurring commissions, and then they've got the advertising and other services like Kayak and OpenTable. Now, for me, when I'm looking at a company, I want a company to have multiple revenue streams, so it doesn't rely on one thing. So, like Meta, for example, if you've seen a video before, that only mostly relies on the advertisement. But 99% of that company is ads. So, if there's a problem with the ad service and the market, Meta will struggle. But Booking has multiple segments. They have ways to make money, not just over one multiple, or just from one revenue stream. They have multiple. So, and also as well, the merchant is growing. The high margin model is growing, and it's consistency across all 3 periods. Like, the growing in terms of how Booking makes its money is growing. The revenue growing. The revenue by segment with the merchant and the agency still growing. That's good. So Booking shows all three once again, and all I can see is tick, tick, tick. So for me, this is why it's an ad. So as well, this is my most important fundamental that I look for, and it's free cash flow and shareholder returns. Now, shareholder returns could be given back in multiple ways. You've got dividends, buybacks, and others, which I can't remember off the top of my head. But the two that I always walk out for is dividends and share buybacks, because I'd rather either get a dividend, which I could either reinvest into a company or reinvest into other positions that I feel like are undervalued, or share buybacks, which increase, the reward in shareholders with growth into their shares, into the company, making the company more valued, which is very good. But how much is it generating? Well, free cash flow in 2016 was just below 4 billion. Now it dropped, of course, in that year of 2020, but in 2025 it was over $8 billion. Now, at this time of year, 2026, the company holds $17.2 billion in cash. Now it has got 19.4 billion in debt, but it shows a strong balance sheet, financial flexibility, which is good. So roughly, Booking.com generates 8.3 to 9.1 billion in free cash flow every year. They also have, like we mentioned, the balance sheet, but the share outstanding have been shrinking, which means they're buying back shares to increase our ownership, which is good. So from 2016, they had 50 million shares. Well, 2025, they're above 30 million, just above, which is good. Strong cash generation, which is good. Healthy balance sheets, which I say is good. And also cash available for dividends and reinvestments, because once again, they also pay a dividend as well as doing share buybacks. So when doing my check-in, well, does Booking.com generate free cash flow? Yes, that's a tick. Is free cash flow growing? Yes, that's a tick. Does it buy back shares? Tick. And does it have more cash than debt? Well, no, but it's pretty much there. So Booking scores highly on all of these, which for me makes it another strong reason this company is an ad. But now we come on to valuation. So my deck includes 3 valuation models: intrinsic, discounted cash flow value, and relative value. Each one has a worst, base, and best case scenario. The worst case scenario shows roughly between 16 to 20% overvaluation. This assumes that growth will be slowed, lower margins, and macro headwinds. In the base case, we're looking at between a 7 to 19% undervaluation, but this is the most realistic scenario. However, in the relative value, there is an overvaluation of 7%. In the best case scenario, however, it shows a 40 to 58% undervaluation. This assumes strong travel demand, margin expansion, which Booking.com is slowly doing. So when we always look at these, we need to realize that we should have multiple valuations that we do, and we need to compare the worst to the best. And these don't always happen. The best scenarios don't always happen, let's say, but neither does the worst case scenarios. No, these are just assumptions and forecasts that could happen. So the booking valuation range for me is attractive because the downside is limited, but the upside is meaningful. So there is value there. And that is why, once again, I had to dive more deeper. So the recent news and headlines. What should we go on to? Now, Q4 2025 result beats estimates. So they had strong international travel bookings, which drove revenue and profits above analyst expectations, which, showed strong pricing, strong volume, and good cost control. The global travel demand remained resilient, supporting bookings, merchants, and agency segments. There was some headwinds from geopolitical tensions and current fluctuations that could impact short-term bookings. The brand expansion, which we've covered on, stock impact, so news of strong bookings helped shares recover, but short-term volatility still persists due to global economic factors. As well as lately, the stock actually shot up from when it announced that OpenAI is pulling back on direct checkout features in ChatGPT, which have lifted the online travel stocks, including Booking, because it reduces one potential threat to traditional online travel agencies. But, however, the Iran war and its impact on travel. Well, there's a little bit of a problem. There has been a war, and conflicts in the Middle East often cause a lot of things, which they have done. Flight cancellations, rerouted air traffic, reduced tourism because people get scared, higher fuel costs for airlines, which temporarily reduce bookings. Now, we have mentioned that Booking doesn't own airlines, restaurants, and all that. They just do the consumers. But if airlines struggle to get their planes up in the air, then the consumers like us who want to go on holiday will get impacted, which means bookings won't be able to book people's holidays. So, Booking earns revenue globally. The currency swings affect reported earnings. So if there's higher travel costs, people won't go. If the oil price spikes, which it has done, companies that they help out struggle. And like we've mentioned, the consumer sentiment shifts. People may delay their international trips, their long-haul flights, and travel to nearby regions, which can cause a short-term dip in bookings. But this impact, though, is usually temporary. Travel rebounds quickly after events. People shift destinations, not cancel travel entirely, and Booking benefits from the global diversification that they have in their portfolio. This is why it could be short-term volatility, not long-term damage. So why did I add bookings though? Well, I added bookings to my portfolio because it's a market leader in online travel, owning multiple brands. It also generates the high free cash flow that I like to see, which will support its dividends, share buybacks, and reinvestment in its business. The company has also rebounded strongly from the pandemic, showing resilience in the global travel demand. And with the growth trends in global travel and expansion of tech-driven convenience, Booking represents a long-term growth opportunity that fits well in my portfolio. So is it add or avoid? Well, I think you guys already heard me say this multiple times. The decision for me is add. It's attractive at the current price. Now, while Booking Holdings faces a short-term volatility with the risks of the war, the company remains a market leader in online travel, like we keep mentioning, and of course with the valuations, the value scenarios, and suggest that this stock is fairly valued to undervalued, offering a reasonable margin of safety for a new investment. That said, though, there are very clear positives supporting this investment case. The strong revenue growth, the rising gross bookings and rooms nights sold, reflecting the travel demand, the high free cash flow, the portfolio of multiple brands, the strategic investments in the AI and platform improvements to maintain a competitive advantage, and the tailwinds from expanding global travel and tech-driven convenience. Now, before this video, I did actually just see some news when recording this that there was a stock split as well that's going to be happening to the company. So you get more shares, and of course, stuff will lower down. I will probably have to do another video on that when it does happen. But for these, I think this strength still, even with the stock split coming up, these strengths make Booking Holdings a solid growth and a cash flow stock. And at current levels, it offers an attractive opportunity to add to the portfolio for long-term growth. Now, I hope you guys did enjoy me doing a stock analysis on Bookings Holdings. Now, I hope you guys did enjoy. If you want me to see more and want me to cover any other stocks or any other subjects, then of course comment down below. And yeah, I hope you guys enjoy. Leave a like, hit the subscribe button, and I'll see you on the next one. Goodbye.